Very good afternoon. It's 4 p.m. and I'm delighted to welcome you to the WTS Dhruva webinar analyzing the provisions of the UAE corporate tax law. It's a privilege to talk to all of you, and not surprisingly, when we sent out mailers talking to people about the webinar, we had a very massive response with hundreds of people sort of registering themselves for the webinar. It will be our effort that over the next about an hour or so, we take you through the provisions of the corporate law, which has been anticipated for quite some time. As you are all aware, this was a law which has been in the sort of resolution in the case of making for the last several months. The consultation document was issued way back in April 22, and almost from August we have been waiting for the law to come out, and finally it did come out on 9th of December. This webinar will be for about an hour. Our effort on this webinar will be not only to take you through the provisions of the law, but also to tell you what are the things that concern you. What is it that you need to be alive to? What is it that you need to be conscious about as you move forward? And how does the law impact you practically on a day-to-day basis? We have kept some time after the webinar for question and answer. And we do, like, I can already see questions being posed. So please feel free to post your questions on the chat box, and we'll be happy to respond to those questions as we go along. The webinar itself is broken up as you would expect, to talk to you about the analysis of the law, how do you compute the taxable income. There are some very interesting anti-abuse provisions we'll talk about, and several other aspects and the next steps that you need to take. And my colleagues Venkat and Kapil will take you through that. But before they do that, I just wanted to make a few points which I think are very, very relevant. One is that there have been a number of developments post the consultation document till now. So from April 22 to December, number of representations have been made. And many of those representations have been considered, and many of the challenges that we saw when we were looking at the consultative paper have actually been taken away. To give you an example, there was this huge issue about dealings that take place between related entities which are in free zone and in mainland. And there was a provision in the consultative document that this would be a subject matter of disallowance, and that gave rise to multiple interpretations. What has now been provided, as my colleagues will take you through in detail as we go along, is that those transactions can take place. A dealing between a free zone enterprise and a mainland enterprise is not at all fatal. However, they need to transact on an arm's length basis, which is very, very sensible and something which is very, very welcome. And this is the approach which we see emanate throughout the provisions. So we have about 70 odd provisions, and what we see is the simplicity which comes out in many of these provisions, and how the representations that were made in the course of public consultation have actually been given effect to. While the provisions are effective from accounting years starting after 1st June 23, which is what was the original proposition, there is an aspect of the law which has actually been made applicable immediately, and that is the anti-abuse provisions. The law contains what we call as general anti-avoidance regulations, and these regulations apply within a fortnight of notification of the law, and therefore are applicable immediately. And it's quite interesting to note that as tax advisors, we always tell our clients that whenever you restructure your operations, your restructuring should have a business purpose. A restructuring which is driven only by taxes is not something which is welcome at all. And sure enough, the law has now come to say that any restructuring which takes place hereafter, which is driven only by tax advantages and not by commercial considerations, would be disregarded. And that's consistent with how such provisions apply globally, how OECD itself looks at general anti-avoidance regulations. However, it's worthwhile to note that those of the entities in UAE which started their journey early to understand the impact of the provisions, the consultative document, and started sort of implementing changes, will not have to pass this additional threshold of having to prove that whatever restructuring they did was not abusive. Others will need to do that. But as I said, be that as it may, one always needs to be very, very conscious when one is restructuring that one does not fall foul of anti-abuse provisions. Another important aspect which comes up and which is going to be very, very critical is that transfer pricing provisions are going to be very, very important. Whether one deals with related parties, as I said, free zone to mainland, etc., you will need to comply with transfer pricing regulations. And we need to ensure that we are so much compliant. Again, the good part is that while transfer pricing provisions apply even for dealings between entities which are related and which are having the same rate of tax, there is a provision for a correlative adjustment, meaning thereby that if there is an adjustment on one leg, there is a corresponding adjustment made in the other leg, and therefore there is no double taxation. And again, I'm sure as Kapil takes you through those provisions, he will explain that to you in a bit of detail. But you need to be just alive to this fact that transfer pricing is a very important and an essential ingredient of this entire law. I spoke about anti-abuse, and one other point which just comes to my mind is that there is a degree of subjectivity in the anti-abuse provisions. Not at all unusual, happens in such provisions all over the world. But what is indeed provided is that if there is any restructuring which has taken place, which is inconsistent with how the law was conceived, then it could be disregarded, and that could turn out to be sort of quite subjective in its nature, and one needs to be very, very cautious about it. Many of the provisions, and there are just 70 articles, so in that sense, the law is, as it fairly simple, but many of the provisions are fairly progressive. So for example, the ability to carry forward losses year after year without any limitation, subject of course to the quantum, and again, Venkat, as he deals with this whole provision, will talk to you about it, is very, very welcome. The ability to do grouping is going to be very, very important. So you can form voluntarily a group of entities. And if there are transactions between the group entities, then those group entities don't need to comply with transfer pricing. And again, there is a provision that if there is a change in shareholding, losses may lapse, but again, a relaxation there, which again is very unusual and very, very welcome, that if the same business continues, then even if there is a change in shareholding, the losses will continue to apply. So overall, very progressive legislation. I see many of the things which are consistent with global practices and OECD practices. The final comment I would like to make is that while the rate of tax is 9% applicable to taxpayers who derive income of more than 375,000 dirhams, one needs to be alive to the fact that we have Pillar 2. And while Pillar 2 does not find any mention in the law because it has not yet been implemented, there is a specific FAQ on the subject, meaning thereby that as and when Pillar 2 is implemented globally, enterprises which are covered by Pillar 2 will need to comply with those provisions even in UAE, and the rate of tax would be made specifically applicable to them, presumably the globally accepted rate of 15%. So again, while free zone enterprises are free from tax, if they happen to be part of an entity which is covered by Pillar 2, they will need to comply with those provisions, and we need to not lose sight of that. So, and of course, it applies to all entities, whether in free zone or otherwise, but that is something we should not lose sight of. So with this broad background, if I can turn over to my two colleagues, Venkat, who's our partner based out there, and Kapil, who's our senior director based out there. Venkat will deal with the provisions of the law, and Venkat will deal with the provisions of transfer pricing, and then we'll come back to the question and answer. And I look forward to having a very meaningful session with you. Over to you, Venkat.
Thank you, Dinesh. Good afternoon, everybody, and thanks again for joining us. It's indeed a pleasure to bring this to you. A quick recap, the timelines. We started in January. This journey started in January 22. April 22, there was a consultative document. 9th December, we have the English translation of the law. And we are looking forward to corporate tax being applicable for financial years starting after 1st June 23. For Pillar 2, it would be safe to assume that it would be Jan 24, and UAE will notify whenever the rules are to be notified there, because once the global agreement is reached and signed off. The tax law overall has multiple aspects covered, whom they cover, what are the exemptions, and how it is really taxed. And I'll try and go with one aspect of it at one time. The covered persons are UAE juridical persons, which includes a free zone, which means any incorporated entity, who's not an individual, not a natural person. A foreign juridical person who may be controlled from UAE, which means if there is a business outside in any other country, which is entirely controlled from the UAE, which is the place of effective management concept, they would also be brought and treated as residents. Individuals carrying on business, and this individuals carrying on a business, whether it is the type of business or what activities would be covered, have to be notified. The residual provisions being with the authorities to notify any other person whom they may want to bring into this. A non-resident would be other than the residents who are having a PE, a permanent establishment in the United Arab Emirates, or a UAE sourced income, or a nexus in UAE. Now, it sounds very straightforward and simple. Permanent establishment based on principles which we have a slide on as to who constitutes a permanent establishment in UAE. That is one part. The UAE sourced income can have a very wide impact, and so could the nexus. While the nexus has not been specifically defined, this would be the ambit of tax for a non-resident here. The resident juridical person would be taxable for any income derived in the UAE and outside the UAE. Business income and capital gains will be subject to tax. Resident individuals from the specified businesses, the individual incomes like a salary for an individual or interest, unlikely to be taxed and out of the scope. The source, again, we come back to the non-residents, which I mentioned earlier. For the incomes which are UAE sourced are likely to be taxed, and the income attributable to a nexus. This would be the base, how you would determine what is your corporate tax base and who are the people covered for what incomes. The permanent establishment rules which will come in is they will determine who's got a fixed place permanent establishment. Typically, these are branches, offices, factories, installation sites. A dependent agent PE would be an agent who concludes contracts or concludes all the business of a person overseas, and which we call the typical DAPE concept. The construction PEs would be any sites where a foreign juridical person has a site in the UAE, and the timeline is 6 months. So something of a short duration may not attract this clause. There is no service PE. Clause. These are fairly straightforward and what are internationally accepted definitions of permanent establishment. So it is not a surprise in any way. Exemptions provided would be for any preparatory and auxiliary activities. Again, this is in line with usually tax treaties which provide for this. However, an anti-abuse provision to say that if you are trying to split your preparatory and auxiliary activities to somehow avoid this PE or extend your time, that would not be looked at favorably. Typically, globally, the international, the investment managers and funds, there is always a discussion as to where should they be taxed and how will they be taxed. There are specific steps and rules given for that. So an investment manager subject to those conditions would not be taxed here. A temporary presence of employees engaged in non-core, as we said, would be not constituting a PE and would not put the foreign juridical person to tax, which is a welcome one. Overall, if I take away from this provisions, these are in line with the global tax treaties which are signed, and even UAE has signed a number of these treaties, so it's in line with the same. We spoke a little bit in the couple of slides about what the UAE sourced income is. Now, if UAE sourced income is wide in scope, it covers any, and also it covers the incomes of a UAE resident and a PE. Service income within the scope if rendered and benefited. This one we have to be mindful. If you read literally, it means that a service income, when it is defined, if it is utilized and benefits in the UAE. So you may have paid for it for a service provider who is outside the UAE, but it is paid for, then it is utilized and benefits within the UAE. It is likely to be brought into tax here. That said, all these which I'm talking about, whether it is sale of goods, whether it is sale of goods or services, please factor in mind that the double tax treaties will apply. And therefore, you will look at the favorable provisions there. It is not automatically that it has to be. So therefore, you would probably consider if a non-tax treaty resident is dealing with the UAE, this could cause issue of taxation here because there are no treaty provisions, treaty protections available to the person. The use and right to use and the permission on intangibles are typically provisions which suggest that at some point when royalties are supposed to be taxed, right now it's a 0% withholding. If and when they are taxed, that will be an enabling one. The interest from a UAE resident is very interesting. That is, if you're earning interest from a UAE resident or the government, then it would be taxed here. It would be deemed to be a source in UAE. The other one, which is a little bit of a surprise, if secured by a UAE property, as to how the implementation will happen, one is not clear. But what it suggests is that if there is a UAE property which a person who's a non-resident is owning in UAE, mortgages it or borrows against it in a foreign country and pays a foreign resident again for the interest. So except the property, the borrower and the lender are outside the country. How would you tax that interest, or how would you bring that person to tax is the question, but it is covered here. It's a wide scope. Similarly, for insurance premium, if the asset is located in UAE. Broadly, while we have all considered right from the consultation document that 375,000 dirhams is the tax limit, it is yet to be notified in a cabinet decision, but for all discussion purposes, we continue using that number of 375,000 dirhams. If it is below that income, there is no tax. Above that, at 9%. For a free zone who qualifies, it would be at 0%. And if a free zone opts to pay tax because of their own peculiar circumstances of whether it is a mainland income or if they are unable to comply with the conditions of a free zone, they may choose to get taxed at 9%. And that could be well a possibility for many free zone companies who are very happy being in the free zone, but would just prefer to pay taxes. But otherwise, they would be on a 0%. I would urge you to look at, as Dinesh also mentioned earlier, if you're an M&E and a Pillar 2 provisions, and we will talk a little bit more as we go along when our Pillar 2 conversation comes in, the whole OECD BEPS Pillar 2 and the whole tax around it, globally, while it is not settled on the date, those timelines have moved from January 23 and it's likely to be on January 24, nothing official about it. It is. And the UAE tax law, just like every other domestic tax law, has not brought provisions because the date of implementation is not clear, etc. They will bring it into the law, and the ministry will bring such provisions which are applicable. From the consultation document, we know it's a top-up tax. Globally, we know it's a race towards 15%. So for our discussion purposes, if we say that 9 is going to become a 15 for an M&E, so what you may want to take away is, for an M&E, that is a multinational enterprise or a MNC, if you choose to call them, have a turnover over euro 750 million, the equivalent in dirhams, about 3.15 billion. The likelihood of your tax rate is not 0 or 9 as applicable, which maybe without that, it could go up to 15 or such top-up tax which is named. You may want to also consider the fact that these are mentioned on Pillar 2 on FAQs on 118, 157, and 158, specifically explaining this. The big one for UAE taxpayers and residents and people who are operating out of the free zone, those holidays, those tax holidays subject to conditions and those qualifying incomes being defined would be protected at the 0% rate. If they don't opt for 9%, they would be protected with 0. The welcome provision, as Dinesh also mentioned, that there was a provision there was a point in the consultation document that if a free zone entity deals with a related party in the mainland, the payments made by the mainland would be disallowed. That provision is not there in the law. It was possibly a representation by many people. Neither is there the conversation about the branches of a free zone person. Having said that, it is a deduction, and it's a very fair assumption that it is not, you could do anything between a free zone and a mainland without any restrictions. You may want to look at, and it would be a natural thing to assume that robust transfer pricing compliance and a benchmark would need to be done so that the authorities are satisfied that the profits are not being shifted between the mainland, which is a 9%, or a free zone 0%. Besides this, the anti-abuse rules having been notified in the law, you have to be mindful whether you're in the free zone or even outside, but definitely in the free zone, apart from your substance requirements, that you're mindful of the anti-abuse rules and you're not just placing yourself in a free zone and not with enough substance to gain the 0% benefit without any real substance to prove for. There are a host of exemptions, automatic exemptions for certain entities, government entities, except when they are involved in a business activity. There are specific mandated business activities which a government-controlled entity may carry out, which may be exempted. Otherwise, they may be taxed. The extraction and exploitation of UAE natural resources, typically in a common sense, we say natural resources, but in our mind, it is the oil and the refining business. Those would be exempted. And the reason for that is they are probably governed by the Emirates level taxation, which is a far higher rate of tax than the corporate tax regime. So therefore, they would be exempted. You would need approvals for exemption, and there is the guidelines, and there are provisions mentioned for how a qualified investment fund would gain, what conditions they need to satisfy for the approval for the social security and pension funds, and any other person which the cabinet may decide. These are welcome steps because typically in any other, once the tax regimes kick in, these are the questions which are asked about what happens about these funds, what happens about social security, and what happens about any other public benefit or organization which they may do that. I'll be switching over to, after this background, we have laid out as to when the law is applicable, who benefits, what is the tax limits, what are the tax rates, free zone apart. You come down to the computation of the taxable income. The accounting profits as per the financial statements would be the basis that continues. IFRS being probably the most preferred in the UAE or any other notified acceptable standard. They may specify this by some fashion, or it is an acceptable accounting standard. Audits of entire financial statements not yet brought in as a legal requirement, but one safe to assume that apart from this small business relief and any other point, there could be a threshold which they would specify that beyond these turnovers or incomes, there could be an audit which is compulsory. Right now, nothing, but it may come about to be specified. You would make to your adjustments. So automatically would your profit statement in your financials become the taxable income, while accounting profits and accounting results will be respected and they are the basis of your computation. That is, it is not that the profit which comes in there becomes the income. There would be adjustments because of the provisions, unrealized gains and losses, how you choose to account for them and how you choose to get them taxed or not taxed on the basis of realization. Exempt incomes, which we have defined earlier, if you have it in your computation, you will not tax it. There is a list of non-deductible expenditures, and we'll come to that about interest and entertainment. There would also be an adjustment required for transfer pricing adjustments. As a corollary to all this, therefore, your profits would change, your book results would be one, and then after all these adjustments, your taxable income would be different, which would automatically necessitate your accounting entries for deferred tax assets, deferred tax liabilities, etc. Some of the exemptions which are notified, and they are very welcome, one would say, dividend from a UAE entity. So it doesn't matter if you get dividend from any other corporate gets a dividend from a UAE entity, whether from a free zone entity or whether from a mainland entity, that is tax free. It would not be taxed. Dividend from a foreign entity subject to participation exemption, and we'll talk about participation exemption. Those criteria, conditions are there. Same for capital gains and other income. Typical, which you would see as a benefit across the world, income for a non-resident person who's operating who's operating aircrafts and ships in international borders or international space would be tax exempt. The participation conditions are, just to avoid the shell or the rand, small investments, or just for, booking investments. The conditions would be 5% or more ownership. So you would have an investment over 5%. So it is a little more than a casual, normal, small investment. A strategic amount, it would be, it is yet to be defined, a threshold will be set. You would hold that investment for at least 12 months. These are conditions. This 12 months condition was not there in the consultation document. The tax rate of the investee entity is 9%, but the free zone, even if it is 0%, is deemed to have met this. Direct and indirect ownership held by the investee entity, which otherwise would not have satisfied the participation conditions, that would not be violated, not to exceed over 50%, or any other conditions. If you sum and, if you kind of add all this together, assuming that a company of substance is being invested in, the UAE will make itself automatically, it was always, and it will continue to be an attractive holding company jurisdiction, because it is not seeking to tax something which is already taxed in another geography, and therefore, and definitely within its own. So therefore, it would have its attractiveness in terms of a holding company jurisdiction. Quickly on the expenditures to be disallowed, a very natural and logical corollary that if what you are earning is exempt, it should be follow that whatever expenditure you incurred to earn that income would be disallowed. So expenditure which can be proven to have been incurred for earning that would be not allowed for a deduction from tax purposes. What continues from the earlier consultation document, the 50% of entertainment expenditure will not, 50% will be allowed and 50% will not obviously be allowed. And there is a list provided. Typically, it is not for the employee and the staff welfare stuff, but otherwise for entertainment and guests, and there is a list provided. The net interest expenditure shall be deductible only up to 30% of your EBITDA. This, I think, was a cause of a concern for a number of taxpayers, especially people who have borrowed heavily, or they have projects which have high gestation period and the profits are low initially. And a welcome provision is that the disallowed interest are allowed to be carried forward for 10 tax periods. So while your otherwise losses are carried indefinitely, at least for the interest part, it is carried for 10 tax periods. So the permanent loss doesn't happen if your interest is disallowed. Of course, for entertainment, that's a permanent loss if you get a disallowance, but not on interest, and which is a very welcome provision. Well, businesses will have profits and pay 0%, either 0% tax if they are in the free zone, or 9%. The other side of reality of business is that you could have losses, and losses, the UAE, the tax law now provides that losses can be carried forward for an indefinite period. There is no distinction on what type of loss. It is a loss, and that can be carried forward indefinitely. However, whenever you seek to set it off in the future years, it would be 75% of it. So you end up paying tax on the remaining 25%, and then you take that what is not set off for the future period. Any loss which you incurred before the tax law kicks in for you will not be allowed to be carried forward or set off. And so therefore, because the incomes are not taxable, so neither will the losses be. A 50% common shareholding to be maintained in the year and up to the year in which it is set off, except that the same business is being continued, but the same business needs to be continued only when the shareholding is changing beyond 50%. If the 50% is continuing, that business could be not continued, and it could be another business. Of course, this doesn't apply to a listed company. There is a provision for transferring tax losses between group entities. So if there is a common shareholding of a 75%, you could transfer your losses so that the other entity would claim the loss. The conditions obviously would be that both are not exempt, and it's not a free zone person, etc. And the financial year and the accounting standards used by both the entities so seeking that are the same. So all those parities will be there. This is a big requirement. It was a big requirement, and it was a big provision, which is something which all the groups have looked forward to, from an ease of compliance and how do you form your tax groups. So the first, before we start on corporate tax groups, we should say that there is a concept of VAT groups, the VAT groups in UAE, but the VAT groups and corporate tax groups have nothing similar. They can be too different. And the CAT and the CT groups are something which are formed voluntarily, in the sense you may choose to do it or you may not choose to do it. Overall, while we say 375,000, if there is a different number, it is fine. But overall, the limit would be applied for the group, in the sense that if a group has, say, 100 companies, it is not that your taxable limit will be 100 into 375,000. It will be just 375,000. And like I said, I use 375,000 commonly because that is what we are kind of expecting, unless it is a different number. But it's one amount of 375,000, not into the number of entities which you are there. The tax groups can be formed when you own 95% of the shareholding and the voting rights. And if it goes below, and you can, once you control that, then you can form a tax group. Within a tax group, and while Kapil, my colleague, will take over on talk about transfer pricing provisions and how they would apply, they will not apply if you are tax grouped. You may be in the group, but if you're not tax group, it would apply. But if you're in the same tax group, then there's no need of a transfer pricing compliance because they cancel out each other. While you can join the tax group, once you join, exiting, and all these approvals are based on the exit, these conditions will be subject to specification, and the FTA approval is required. And there are conditions or as to, specific conditions when the group changes, then what happens. So basically the losses you came in with, you will, if you go out of the group, you will go back with your losses. There are losses which, if it was incurred as a group, will remain with the parent entity, and that will not change. Those conditions have to be fulfilled. So yes, you can form a tax group, bring all your group entities together, as long as you have 95%, and you can ease your compliance and file one tax return, and ease of compliance, no transfer pricing, and offsetting the losses and profits of each other within the same time. And then you can go forward and file as a full entity as one return, ease of compliance. The general anti-abuse rules, or the anti-abuse rules chapter, which has come in, and we commonly refer to it as GAR provisions internationally and everywhere. It tends to be used as general anti-avoidance rules. Here it is general anti-abuse rules. And in simple terms, it is what it says. It is, do not abuse the tax provisions. And the point is that if you have a transaction or an arrangement which lacks commercial substance, which is only on paper, and one of the main purposes, or the main purpose, or one of the main purposes, is to only play around with your tax liability or take a corporate tax advantage, this arrangement could be disregarded. And these provisions are applicable from the date of publishing, as Dinesh mentioned, whether you look at it, whether it is an October or a December date, once you consider that the tax law is published. So even though your tax year may start in June 23 or in January 24, these provisions are in the law and from the day the law was published, i.e., if you are now planning to do any of your restructuring or any of your planning in the group, or when you're putting in arrangements in your group, you have to be mindful of the provisions of anti-abuse, and therefore the rigor which you will do to explain your transactions would be a little more, in the sense that you will have to justify what was the commercial substance, what was the rationale for doing all this, etc. So the old, and Dinesh talked about it, we would always, whenever we do any business restructuring or any planning, we would always talk about, what is the substance, what is the legality of it, how are you planning to achieve your goals, etc. It cannot be just driven by one objective, which is tax advantage. And once it is a commercial rationale, then this should be fine. So it just requires a little more rigor, little more thinking through, and then implementing your ideas as to going forward. It's definitely not to say that you cannot move forward with your ideas. You just have to have more rigor into your transactions. I will now request my colleague Kapil to come in on the transfer pricing provisions and a couple of slides, and then he'll take it forward from there.
Sure. Thank you, Venkat. Thank you for the handing over. With the introduction of corporate tax law in the UAE, another key provision which has been introduced are the transfer pricing provisions. Now, the transfer pricing provisions in the UAE are based on the internationally recognized and globally accepted OECD guidelines. They are applicable on transactions between related parties and connected persons. And additionally, from the public consultation document, an additional definition of related party has been introduced. Related parties will now also include persons who are trustees, founders, settlers, or beneficiaries of a trust or a foundation. Interestingly, transactions between two mainland entities or two free zone entities, which means having the same tax rate, will now also need to comply with the transfer pricing provisions. Popularly, we know this as domestic transfer pricing, and this has been clarified by the FAQs. Also, the transactions between exempt and non-exempt activities of the same person will be subject to transfer pricing, and all these transactions will need to be held at arm's length price. Another key aspect which has been defined under the law is the definition of control. And why this requires a specific mention is that under the IFRS, the definition of control is different, but as per the transfer pricing regulations, the definition of control has been kept very different. This would be very key when taxpayers and companies are determining relationships and identifying related parties and connected persons. As mentioned earlier, under the public consultation document, the disallowances were proposed to happen when a free zone entity was interacting with a mainland entity, and such transactions were to be disallowed at the hands of the mainland entity. However, now that provision has not found place in the final law, and now these transactions would be allowed, albeit they need to comply with the transfer pricing provisions. Venkat, can we go next? Thank you. The arm's length price needs to be determined based on the prescribed methods under the OECD. Under the OECD, there are 5 methods prescribed for determining the arm's length price. And in a very welcome move, and in order to ease compliance, the regulations have provided for that the taxpayer is free to apply any other method if none of the 5 methods which have been prescribed can be reasonably applied to justify the arm's length price. Now, this will give a lot of benefit to taxpayers to benchmark, number one, the complex transactions, and also to benchmark the transactions which would be more closer to the commercial and business realities. Rather than just focusing on the mechanical methods, this would really give us the option to taxpayers to choose for a method which is more driven by substance. Again, in a rare move and a welcome move, a combination of methods is permitted to justify the arm's length price of a single related party transaction. Globally, this provision has found very less space in very few countries. Finland, New Zealand, Slovenia, and Lithuania are the 4 countries which come on top of our minds where such combination of methods provision is specifically mentioned in the statute. This would again help taxpayers to benchmark complex transactions by using multiple transfer pricing methods. And this again is going to ease a lot of compliance. Wherever the transactions are not held at the arm's length principle, the authorities may go ahead and adjust the taxable income. However, a corresponding adjustment to the taxable income will also be made to the other party. Similarly, if an adjustment has happened on the has been done by the foreign competent authority, an application can be made by the taxpayer to make a corresponding adjustment, and this would reduce the impact of double taxation. Venkat, can we go next, please? Thank you. With respect to payments to connected persons, whenever such payments are being made and they are not adhering to the market value, such payments to connected persons will not be deductible for tax purposes. The determination of the market value would be in line with the prescribed methods under the OECD, and the implementation of these would need to be closely looked at. There is an exception provided to companies, which means that whenever a company whose shares are traded on a recognized stock exchange, they make payments to connected persons, such transactions need not come under the ambit of transfer pricing. The rationale behind this could be that the companies whose shares are traded on the stock exchange typically have independent board of directors and members to monitor the payments being made to related parties. And accordingly, these transactions may be compliant with good corporate governance and arm's length principle. With respect to tax grouping, transfer pricing will not be applicable when all the entities of a group form a tax group because of the elimination of such transactions. However, it would be applicable if a member of a tax group goes and there is another group company which is not a part of the tax group, then the transactions between the tax group and the outside member will need to comply with the arm's length principle. Also, within the tax group, if there is an entity which is computing standalone taxable income for utilizing tax losses, such transactions with such entity would also need to adhere to the transfer pricing provisions. Next, please, Venkat. Thank you. With respect to the compliance requirements, a TP disclosure form will need to be filed along with the tax return. The notification will be released with respect to the contours and the form of the disclosure, but that is something which needs to be filed along with the tax return. Taxpayers will also be allowed to maintain a master file and a local file. Now, this completes the OECD's 3-tier documentation under Action Plan 13. All of us know that the CBCR provisions are already in place for the past 2 years in the UAE. The master file and the local file provisions also come in, which complete the Action Plan 13 compliance under OECD. The transfer pricing documentation provisions shall not be applicable for small businesses. This is a relief for small businesses, and the determination of the threshold for determining whether a business classifies as a small business will be notified. The threshold would be the revenue earned by the business activity. There is a mechanism in place to apply for APAs. APAs typically would be to seek a clarification from the authorities in advance for determining the arm's length price of a transaction. Also, conditions, thresholds, limits for transfer pricing applicability will be determined. It is advisable that the transfer pricing documentation is maintained on a real-time basis, as the timelines to submit the TP documentation when requested by the authorities is limited. As per the statute, the taxpayers will be provided 30 days time to submit the TP documentation once the FTA requests so. Maybe move on to the next, Venkat, please. Now, what we've seen is that basis our discussion, that transfer pricing will be applicable on a large number of business arrangements, not only between entities which are subject to 2 different tax rates, but also between entities which have either a similar tax rate and also to connected persons. Accordingly, planning for our transfer pricing becomes absolutely imminent. What taxpayers can do right now is to first identify their related parties and connected persons. As mentioned earlier, IFRS accounting has a different criteria to identify related parties. we should go ahead, analyze and assess the impact of the transfer pricing regulations to identify the gamut of related parties and connected persons and start mapping their transactions with them. If there are an existing transfer pricing policies in place within the group, the taxpayers should start reviewing and updating their transfer pricing policies based on the law which has been announced, based on the arm's length principle, and should clearly make any modifications to adhere to the arm's length principle. Since there are many exemptions being provided to tax groups from a transfer pricing compliance standpoint, from a tax position perspective, tax groups should be formed on the basis of commercial realities, which would reduce your transfer pricing compliance requirements. The IT systems need to be updated so as to reflect the related parties and connected persons and their relationships. OECD has already since long released the formats for master file. Accordingly, taxpayers can proactively start creating those documentation in order to prepare themselves for the upcoming compliance requirements. And most importantly, since a lot of transactions will need to be adhered to the arm's length principle, the identification of benchmarking requirements need to be understood as to how much benchmarks would need to be there, what methods are to be applied, etc. And that is one of the key aspects which typically the taxpayer should look out for. Venkat, can we just move on to the next? There are certain other key aspects which have been announced in the UAE corporate tax law. There was a discussion whether the VAT TRN numbers can be used for registrations for corporate tax purposes. It has been clarified that there would be no carryover of VAT registrations for corporate tax. In case of a conflict between the domestic law provisions and the treaty provisions, it has been clarified that the beneficial treaty provisions should apply. If a taxpayer intends to change the tax period, for example, the tax period of a taxpayer could be July to June, they want to shift it to January to December, it requires a specific approval of the FTA, providing reasons, valid reasons as to why such change is required. The provisions with related to penalties and fines will be introduced and they are awaited. Similar to the VAT regime, it is possible for taxpayers to approach to the FTA for seeking clarifications on any aspects, on any transaction, and this would also include any advanced pricing mechanism or arrangements to be discussed with the FTA. The records, the tax records, which are prepared by taxpayers and multinationals, need to be maintained for 7 years following the end of the tax period. Can we move on to the next? Thanks. In terms of the settlement of corporate tax, the corporate tax has to be settled at the time of filing the income tax return. So there is no concept of advance tax, which takes away the burden of cash flow on an organization. The settlement of corporate tax will be 9 months from the end of the relevant tax period. The order of settlement would be with respect to first the withholding taxes, which is currently at 0%, and then taking a credit of any foreign taxes being paid. The 0% withholding tax rate shall apply on certain UAE source income, which will be prescribed for non-residents. In terms of the foreign tax credits, the foreign tax credits shall be allowed with respect to the foreign source income, which will be the lower of either the tax paid in the foreign country or the UAE corporate tax paid on the foreign source income. Any unutilized tax credits cannot be carried forward. Neither the FTA will provide a refund on any such unutilized credits. So now that we've looked at the broad, the contours of the law, Dinesh, can you just have some next steps and the concluding remarks, please?
Sure. Thank you, Venkat, and thank you, Kapil, for those that very helpful analysis. So where we are, we now have the law. And as we work with several of the clients, we have found people, larger clients particularly, have already commenced long back an impact analysis based on the consultative document. Now that we have the law, it is imperative that we commence quickly an impact analysis of what the effective tax rate works out. And it's just simple to understand that at 9% tax, effectively your profit before tax gets diminished by 9% because of the corporate tax. And therefore, if there are legal legitimate means within which one can sort of try and mitigate the implication, one would need to start considering that. We mentioned earlier about Pillar 2, and that is again something we must not lose sight of. I mentioned earlier, for example, about anti-abuse rules as to how if you would have restructured before this law came into effect, then you might not have to undergo the additional pain of demonstrating that you are not foul of anti-abuse rules. Similarly, we must not just wait for a period of time to say, we will look at Pillar 2 as and when it is announced. It is around the corner. It's a matter of time before it gets announced. And therefore, if any planning, structuring needs to be done in and around that, any factoring needs to be done, that should be done immediately. For entities which are in free zone, as we explained earlier, there is no tax, and the government has stuck to its commitment that if you are a free zone enterprise, you are not liable to tax. Your income is zero. And as I mentioned earlier on also, that in respect of dealings between free zone and mainland enterprises, all that you need to do is to comply with transfer pricing. And transfer pricing becomes therefore very, very important. You need to ensure that your documentation stacks up and you are able to demonstrate that you are dealing with mainland enterprise or any other related party on an arm's length basis. This is absolutely important. As Kapil explained, one of the very interesting facets of transfer pricing which has been introduced in UAE, which is very, very welcome, very, very few countries in the world have it, is that you can use a combination of methods to justify that transfer pricing norms have been met. And more important, what is important is to demonstrate transfer pricing rather than a mere sort of compliance proposition, which is very, very welcome. So transfer pricing, free zone become very, very important. We spoke earlier about anti-abuse rules, and that's something which is going to be very, very critical. In fact, as we start going through the questions, many of the questions which have come in is that what if we start now paying salaries, we start paying rent, etc., etc., etc. Would those be covered by anti-abuse? And again, the simple answer is that anti-abuse rules always need to be taken into account. Commercial rationale of whatever needs to be done has to be very, very robust. You cannot expect to mitigate your tax liability using structures which really have no commercial rationale, but that's something we'll need to be always cognizant of as we sort of look at corporate tax. We mentioned earlier on about tax groups, and that's going to be very, very critical. Again, one of some of the questions which have come in is that can a free zone and enterprise on mainland form a tax group? And the answer is yes. That's why you have an irrevocable option of opting that a free zone enterprise, although it is not liable to tax, can opt to pay a 9% tax, presumably because you want to do a tax grouping. So how will you do the group? There are provisions for entry, exit, what can happen before the entry, what can happen after the exit, etc. And those decisions need to be made very, very clearly. In a place like UAE, where most enterprises are into multiple businesses, hospitality, retail, real estate, etc., etc., tax groups is going to be very, very critical. Those choices need to be made in a very, very conscious manner, and a proper evaluation needs to happen. And last but not the least is, are your IT systems ready? You need to be able to compute your taxable income. You need to be able to plan what is your profit. We mentioned earlier on that your accounts for the purposes has to be prepared on the basis of international accounting standards, IFRS, whatever else. And while currently there is no mandate that you need to carry out an audit, it's a matter of time before that gets notified and audit is required to be carried out. And are your systems ready to produce a robust set of accounts on an ongoing basis? Again, we mentioned earlier on today, there is no requirement to withhold taxes. There is no requirement to pay advance tax. It's a matter of time before some of these provisions will be introduced, as is the practice globally. and are our systems robust enough to be capturing all of those as we go along? That's something which we would very, very strongly advocate as a takeaway from this particular webinar as you go back and reflect on how do you respond to this introduction of the new tax. And with that, we move on to question answer. We have several questions. We have almost about 40 plus questions, and I don't think we have time to answer all of them, but we will attempt to answer some of them, and you can rest assured that we will respond individually to others which come up over a period of time. Venkat, do you want to take on some of the questions which have been asked, Venkat?
Yes, thank you, Dinesh. We will, as Dinesh said, try and answer some of these questions. And for people who have more questions, I have put in 2 email IDs of my colleagues, and very happy to answer them. If you have a mail or a question or a thought which comes in later, we'll send you responses on that basis. Those are 2 IDs of my colleagues, and we work as a team, so we'll send that to you. But I'll try and cover quickly some of the questions so that I get more spread on this. Would companies within this is for Kapil. Would right of use of assets be considered for CT purposes? Yes, if the accounting results are the basis to start your computation, so therefore your right of assets depreciation should be allowable. Is there a provision for carry back of losses? No, there is no carry back of losses. Currently, a lot of free zone entities have transactions with the mainland. If they do restructuring now, will anti-abuse provisions kick in? Yes, GAR is applicable because the law, whether you accept whether it was in the 10th October, there is some date confusion about 10th October, but be that as it may, 9th December, and if you take that the law is applicable, today GAR provisions, you will be tested for the GAR provisions. Having said that, as Dinesh very rightly said, and I spoke about it, that once you build in the substance and the commercial rationale, it should be possible to reorganize your business accordingly based on what your commercial rationale, export income, supply chain, etc. So not an impossible one, but more rigor to be done. So nothing to stop you.
Just one point, if I may come in, Venkat, at this stage.
Yeah, sure.
This issue regarding dealings between free zone, mainland, whether we can shift some of the activities, and is GAR applicable? GAR indeed is applicable, as we discussed, to all restructuring. I don't think that's important. I think what the law provides, and which is quite easy to appreciate and comprehend, is that if you are carrying on some activities in free zone and some activities in mainland, you need to ensure that your profits are captured corresponding to the functions, assets, and risks that you carry out in each of the 2 places. So the profits in free zone have to be corresponding with the functions, assets, and risks there, and the profits in the mainland has to correspondingly correspond with the functions, asset, and risk being carried on there. That's what transfer pricing is all about. That's what we need to be conscious. So long as we are able to show that, and so long as we are able to show that any restructuring that we are doing is consistent with commercial requirements, we are kosher, we should not have a problem.
Yeah. I'll turn it over to Kapil in a while. Kapil, there are some questions for you, which I'm sure you've got, but
yes,
highlight any CT impact on individuals owning multiple rental properties. FAQ 40 suggests that if it is held in a personal capacity, it should not be subject to corporate tax. What will be the status of offshore company and free zone company? Both are treated as residents, and possibly the tax holiday, the provisions will apply accordingly. They are within the UAE. So in that sense, you'll have to register, etc. Corporate tax applicable to free zone, either it is 0 or 9, choose what you wish to based on your compliance. Most likely you would want to protect your 0%, otherwise it's 9.
Yeah, and there was a question which was specifically put that if the option is exercised to pay taxes on a free zone enterprise, then it is irrevocable. Yes, indeed it is irrevocable. You make your choice. You do not need to pay taxes on free zone enterprise. But if for any reason you choose that you would like to pay tax, the choice once made is irrevocable.
Dinesh, slightly, that is what we thought, and we have read it. That was in the consultation document, and it is silent in the main law. So there is a feeling that it may not be irrevocable anymore.
Good. There we go. Yep.
Yeah. So it so it may not be irrevocable in the sense that you may have a choice, you may have a second innings, but again, then the question of how do you exit a group, how do you join a group, what are the conditions, etc. Would DTA provisions be applicable? Absolutely. Whatever is beneficial, and that is clearly laid out that the beneficial DTA provisions should be applicable.
Venkat, I think we should answer one or two more questions, and then,
Yes.
as we said, so there has been a question as to whether we can share the recording with the participants. Very happy to share the slide deck as well as the responses to all the participants. We will respond to your questions, which we have not been able to. So a last couple of questions, Venkat, before we wind up.
Yeah, I think you take the couple of transfer pricing questions.
Sure.
Yeah.
So one of the key questions is that what happens to ESR compliance, and very clearly for free zones, the ESR is here to stay. It has been clarified that the free zone needs to determine substance. What happens to mainland entities is something which there is no clarification. But typically, if you have a robust transfer pricing regime in place, ESR compliances should ideally go away. The other question talks about what happens to local comparables, and would there be a possibility to use local comparables? The fact remains that within the UAE, since it's a start of a transfer pricing law, the availability of local comparable data may be a challenge, and hence the authorities may come back and say that the regional comparables and regional benchmarks may be acceptable to start with, but then we will have to wait for the detailed guidelines as to how and what comparables can be used and what data years can be used. Another key interesting question which has been raised is that how will the two method mechanism or a combination of methods mechanism work in a transfer pricing? Now, typically, how that can be addressed in a transfer pricing documentation is that the transaction can be benchmarked by using one method of, let's say, as a primary method, and then a combination of methods, either a price-based, which is a comparable uncontrolled price method, and corroborating it with a profit-based method can be used to do a combination. So instead of just justifying a transaction with one method, two methods are used in tandem. One could be a price-based, the other could be a profit-based.
I think we should leave it at that. And again, to repeat, we will share the presentation with all the participants. Happy to share a recording of this webinar. And also, we will respond to the questions that have been raised, which we have not been able to address on the call because we've been flooded with questions. We have almost 60 odd questions, and which is understandable. Please do remember that the law itself is new, will take some time to settle down. But thank you once again all for participating in this webinar. We had more than 350 odd participants, which was very, very welcome. I hope it was worth your while. I hope you're able to get a fair grasp of the provisions. And we do look forward to engaging with many of you on the next steps which we set out. Thank you once again all for joining in, and have a lovely evening.
Thank you.
Thank you.
Thank you, everybody. We'll sign off. Yeah.